Ladies and gentlemen, welcome. My name is Alex Dworkin and I'm a managing partner at 4D Capital. We specialize in a very unique mathematical approach to the stock market where we analyze the market and individual stocks in three-dimensional space, and when we do, essentially perfect order emerges. On top of that, over the years we've developed a number of very powerful timing indicators, and when we combine them together with our three-dimensional calculations, we can essentially predict what the overall stock market or individual stocks will do going forward. And we can typically do it on multiple time frames. Whether it's long-term or short-term, doesn't really matter. I personally believe our work is nearly identical to what Jim Simmons was able to accomplish at Renaissance Technologies, if you're familiar with Jim. Our firm's goal is to essentially identify stocks that will 2x, 5x, 10x, going forward within a relatively short period of time. And we can typically do that by using our mathematical approach. But what we've done over the last couple of years, we've developed a very powerful software, and that particular software can essentially analyze the entire S&P 500. It can calculate the market and individual stocks in three-dimensional space. And what it is looking for very important upcoming turning points, particularly bottoms for stocks, let's say, within S&P 500. And once it identifies those very clear bottom, it can project already well into the future what the underlying equity is going to do going forward. So that gives us the ability not only to pinpoint the bottom, but also know what that underlying stock is going to do going forward. And that's how we're able to pick out those stocks that will only the best opportunities, essentially, that will 2x, 5x, 10x going forward. So we're in essence looking for the next NVIDIA, Apple, Bitcoin, Tesla, so on and so forth. So today is a little bit different. I don't necessarily have a stock for you to analyze and to look at. So what we're going to be looking at is the overall state of the market, primarily from the fundamental perspective. And there's a number of things I want to look at. One of them is Shiller PE ratio, and the other one is a Buffett indicator. Now, there are very more or less long-term oriented indicators, but nevertheless it's very important to understand where we are in the overall composition of the market. And then we'll take a look at some of our time and price indicators and what they're saying about the market. Okay, so let's start with Shiller PE. Shiller PE ratio is, as you know, is an adjusted PE ratio for the S&P 500. Very important measure, and as you can see, it is sitting at near all-time high. Currently at let's say 40. Okay, so that makes the market incredibly expensive, historically speaking, as you very well know. So the only other time in history that the index was above this particular ratio was at 2000 top. But from my point of view, and I've been saying it for many years, this particular top, this ratio is a bit distorted, because if you would recall, at that point in time, S&P had many companies that didn't have any earnings at all. So the E in the PE was highly distorted. And because of that, you know, if we make adjustments, I never actually did it or calculated in the proper way, but it's just in my estimate, if we did the adjustments and took out those companies that had no earnings, we would probably end up with a PE ratio of approximately 35. So today's ratio is definitely above that, the true ratio in my opinion. It is definitely above the 1929 top right here, which was about 31, 32. It's putting 2007 top to shame. The top that we had here in 2022, 21 is also quite a bit, well, not quite a bit lower, but still lower at 37.87. So arguably we are sitting with a market, historically speaking, that has been the most expensive market, let's say, in human history, at least as it applies to the S&P and the overall market here in the United States. If we need a confirmation, all we have to do is look at the Buffett indicator. And as you can see, the Buffett indicator is also screaming or putting up an incredible number of red flags as we speak, because it is at a record high, 219. The way we get the Buffett indicator is we divide the market cap by the GDP, and that's what we get. So it's over 200%, 220% as we speak. And if we look right here in the previous top of 2001, or I'm sorry, 2021, it was 193. Here in 2009, or I'm sorry, 2007 top, 102%. And even in 2000 top, it was 132%. So the market, I'm sure Warren Buffett is not sleeping as we speak, but because of this ratio, but nevertheless, this is yet another indicator that is essentially confirming that the market is selling at a record high, more expensive than it has ever been, and anyone paying attention should be very, very worried, let's put it that way, as opposed to be chasing stocks and being excited about the future of AI or what have you. If you've been following the markets as closely as I have over the last couple of days or the last couple of weeks, as a matter of fact, all you can see is bullish articles. The market is not done. The market's going to keep running, and some of the projections are incredibly high and crazy. You know, Dow Jones is going to go to 100,000 within 2 years, and the NASDAQ is going to go here and there. So, point being is that everybody is extremely bullish. The indicators that we're seeing are at historic highs, and investors should be very, very worried about what the market's going to do going forward. So, with that in mind, let's take very quickly look at what some of our indicators are saying. I'm not going to give very exact specifics about what our calculations are suggesting, but nevertheless, we can take a look at what the composition of the overall market. So if you're familiar with our work, you know what these are. If not, these are basically cycle composites, and this is very simplistic representation of a very complex mathematical concept. And what we do, or our software does at this point in time, it scans the market back, it identifies composites within the market, and it projects them into the future. So what makes matter a little bit more complicated is we have multiple composites running at any given time. So this one you see on the chart in front of you is one of the two composites that is running on the Dow Jones that I always talk about. So this is one of them. There's a secondary composites, and if we put them together, we're going to replicate this particular line very closely. But for our purposes, this is sufficient enough. So I want you to pay attention to one very important variable. So we have a mid-cycle top coming right here, and as you can see, the market is moving into this particular top. And once this mid-cycle top arrives, there's going to be a mid-cycle bottom in at some point next year. So this is what we're looking at before the market bounces again. So this is essentially confirming what both the Shiller PE ratio and the Warren Buffett indicators are telling us. The market is extremely overvalued, and from a timing perspective, it is also indicating that we will see it at top soon, and then we will see a significant decline into this particular major bottom. Now, I talked about before, I believe, on this forum that some are, well, I won't go into our own calculations. I'll simply suggest what our software was indicating. And our software was indicating that once this mid-cycle top arrives, the decline on the NASDAQ will be in excess of 50%. So that's what it's saying. Now, I will not deny or either deny or confirm that particular calculation in this forum, but I just want you to be aware of what the software itself generates. We have to go in typically and verify it by hand, and sometimes the numbers are quite different, but I'm just going to let you know what the software itself is saying. And it was saying, once again, that once this mid-cycle top arrives, the mid-cycle bottom, at least from the NASDAQ, will be 50% or more lower. So quite a significant move lower that our mathematical work is projecting. So with that in mind, just be very careful out there. Don't have a fear of missing out, so to speak, and be very, very cautious with this market, because as I just shown you, it is more expensive than it was at 1929 top, 2000 top, 2007 top, 21 if you want to count that top. Yeah, it's that expensive. So the fear of missing out should be turned into a fear of losing quite a significant amount of money, from my perspective. So with that said, we do have a free trial associated with our work, and in that format, we discuss exactly what the overall stock market is doing. We follow it very closely with both time and price calculations. And if you want to get access to that information, please request a free trial on our homepage, the link at the bottom of this video. There's no credit cards, no strings attached, none of that. So I think you're going to find it very interesting and hopefully very helpful. Also, we have a webinar coming up this coming up Friday. It's limited to 10 people. If you'd like to join us, I do encourage you to sign up. Once again, the link is in the description of this video. And during that webinar, we talk about our mathematical approach to the market, how we calculate the market in multidimensional space. We showcase our software, as well as talk about the huge profit opportunities that are available with our work. And of course, we talk about the market. So we take a look at this, and we go into greater details in both time and price of where the market is going to top and bottom and all of that good stuff. So if that would be of interest, I do encourage you to register for our webinar, which is this coming up Friday. Thank you very much for your time. Have a wonderful day ahead, and we'll be back with another analysis of an individual stock. I believe we're going to be looking at Google as soon as tomorrow. Thank you. Bye-bye.